Hey traders, welcome to the How to Use the Trazr video. In this video, I'm going to show you an app that takes the guesswork out of trading. A complete step-by-step guide on how to correctly fill in the position calculator before taking a trade. With this app, you will know the exact position size you should take every single time. That means safer trades, consistent risk management, and more confidence in your strategy. And the best part, it only takes seconds. The first thing you do is choose your account type: retail, prop firm, demo. If you are practicing, select demo. If you are trading your own money, choose retail. And if you are working with a funded account, select prop firm. In this example, I will choose demo. Next, select your account currency. Most brokers default to USD, but if your account is in euros, GBP or another currency, simply adjust it here. Now enter your account balance. Here I've used $10,000 as an example. You will want to type the balance that matches your broker account for accurate calculations. Here is where leverage comes in. You will find your leverage in MT4, MT5 on your broker's website or in the welcome email you received when opening the account. Choose the leverage your broker gives you. It might be 1.30, 1.100 or 1.200. In this example, I will set it to 1.30. But let's pause for a moment, because leverage is one of the most important concepts in trading. Leverage is basically borrowing power from your broker. It allows you to control a much larger trade size with a smaller amount of your own money. For example, with no leverage, $1,000 lets you trade only $1,000 worth. With 1.100 leverage, that same $1,000 lets you control $100,000 worth of trades. Sounds powerful, right? But there's the catch: leverage is a double-edged sword. Higher leverage means you need less margin to open a trade, which gives you more flexibility. But higher leverage also means your profits and your losses can grow much faster. And this explains why sometimes you can't open a position even though you see money in your account. Your broker requires a certain amount of margin to open and hold each trade. If your balance is tied up or your leverage is too low, you simply won't have enough free margin to open something new. If losses pile up, then that's when you get a margin call or even see trades automatically closed. So remember, leverage determines how much margin your broker locks up to let you open that lot size. Next, set your risk percentage. This is how much your account you are willing to risk on one trade. Most pros keeps this between 1% and 3%. In this example, it's set to 1%. By sticking to a small, controlled percentage, you stay in the game long term. Now select your lot size type. You can find this on your welcome email, on your trading platform when you set the volume, or by asking your broker support team. Let me quickly explain why this matters. To measure market movements, traders use pips. A pip is the smallest price movement in the market, and it works as a universal unit across all currencies. Unlike cents or pennies, which only make sense for US dollars, pips provides a common ruler for price changes. The value of a pip depends on your lot size. So in a standard lot of 100K, one pip is valued $10, while in a mini lot 10K, one pip value $1. And a micro lot 1K, one pip is like 10 cents. And in a nano lot 100, one pip values 1 penny. So for example, if you trade 0.10 lots, a mini lot, on Euro USD and the price moves 20 pips up, you gain 20 pounds. If it moves against you by 20 pips, you lose 20 pounds. But if you are trading 0.01 lots in a micro lot, the same 20 pip move is like 2 pounds of your account. But if you trade one standard lot, that same move is equal to $200. So in short, lot size determines the value of each pip, and pips are universal way traders measure price movements across currencies. Now in the Select Asset section, choose the pair, Index, Commodity, Crypto, or future you want to trade. For example, if I want to open a position on Shao USD Gold, I would select it here. Next, enter your entry price. In my example, gold now is at 3,816.42. Finally, decide either to override the pip value or let the system calculate it automatically based on your lot size and the trading pair. Then set up your trade. Choose either you are opening long, a buy, or short, sell. Set your stop loss. A stop loss protects you by automatically closing your trade if the market moves against you. In this case, I've set it to 20 pips. Now we are in the spread settings section. The spread is the difference between the bid price and the ask price of a currency pair. In simple terms, it's the cost of trading. The broker's markup for facilitating a trade. The spread can vary depending on factors such as market liquidity, volatility, and broker type. So the bid price is the price at which you can sell a currency. And the ask price is the price at which you can buy a currency. For example, if the Euro USD is quoted as bid 1.12345 and ask 1.12360, then the spread is 1.12360 minus 1.12345, which is equal 0.00015 or 1.5 pips. Most traders think in pips, but many platforms require you to input points, also called pippets. In the spread settings section, you will find a toggle to view spreads in either points or pips. If you are new or prefer standard trading terminology, choose pips. If you are doing precise work, for example, algorithmic trading or scalping, choose points. In this example, the spread is 15 points, which equals to 1.5 pips. Next, the position fractioner option. This lets you split your position into smaller parts. Also called slicing. This is useful for scaling in or out of trades while keeping your risk management intact. Now we are in the trade preview chart. Start by choosing your reward to risk ratio with the slider at the bottom. As soon as you move the slider, the calculator updates automatically with take profit distance in pips. If you switch from 1/1 to 2/1, notice how take profit moves farther from entry, which is bigger profit target, and stop loss moves closer to entry, smaller potential loss. When the numbers look right for you, lock in the ratio and proceed to the summary. Now you can see the summary of the result of our choices in this section. So based on our choices, you will see the position size calculated for us here, which is 0.05 in standard lots. This is a moderate, well-sized position that fits within my risk management plan. And here the dollar value per pip, which is $100. Each pip movement in price is equals $100 change in profit or loss. This helps me understand how much each market movement affects my balance. And here you see that I'm risking just 1% of my total account. That's a professional standard for keeping losses small and manageable. If the stop loss is hit, I will lose $100, but my trading capital remains protected for future opportunities. Here you can see my reward to risk ratio, which I chose 2:1. This setup aims to earn $200 for every $100 I risk. Even if only half of my trades are successful, this rate allows me to stay profitable over time. Here you can see my spread cost calculated. This is the broker's built-in cost for executing the trade. It's a normal small expense that's factored into my risk-reward plan. It's important to see how much each operation will cost me. And here the margin required, the amount the broker temporarily locks to keep the position open. It's not a cost, but it ensures that I have enough equity to support the trade. And here the ROI snapshot, the return of investment. You see here the return of investment snapshot. If the trade goes wrong and hits the stop loss, I lose 1% of my account. But if it goes right and hits take profit, I gain 2%. Now I have completed my risk management calculations, and I understand both the potential outcomes and limitations of this setup. Market price can change rapidly, spreads can widen, volatility can spike, and price movements can shift even while I'm analyzing or placing a trade. And that's why a position size calculator or trading plan offers only a statistic snapshot of a dynamic, ever-changing market. With this awareness, I can proceed to trade confidently but cautiously, knowing that my decisions are grounded in logic and discipline, not impulse. So that's how I prepare before entering any trade. I hope you enjoyed this video. And please download the app and let me know in the comments what part of risk management you usually forget and how this app can help you become a better trader. Remember, discipline, confidence, control are the keys. Bye for now!